Here's how to handle difficult financial situations with infinite banking. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. I teach people how to live and leave a lasting legacy. For today's installation in our EncycloMedia series, we're going to discuss non-forfeiture options. We're really going to discuss how to use whole life insurance and the infinite banking concept to navigate through difficult financial situations. Now, this is going to be good information to know whether you are vetting the infinite banking concept for yourself or whether you've already bought whole life insurance and then you come into a financial difficulty. So first and foremost, I want to say be familiar with your contract, with the company that you own policies with. And I own multiple policies from multiple insurance companies. So be familiar with your particular contracts. That's my first line of defense, is just knowing ahead of time. Now, the second is having an active and involved and in-depth relationship with your financial professional, your agent, your advisor. If you're my client, that's what we should have, is an in-depth, regular relationship concerning your goals, your plans, your aspirations. Now, I'm not looking to have anybody depend upon me, but I certainly want to be able to bring to bear a decade's experience of having personally implemented infinite banking into my own life and to share those best practices, answer questions, etc. So maintaining an open line of communication, and this can be difficult. If you've hit a hard financial situation, there may be a reluctance to tell anybody anything, but I'm telling you, it will behoove you. It will be to your advantage. Just like you wouldn't withhold anything from a doctor when you're going in trying to figure out how to best navigate some difficult health situation, you don't want to withhold information from your financial professional. Don't let that hold you back. Be open, be honest, be forthcoming, be proactive. Maintain those open lines of communication. That's my suggestion. And then before we talk about the nuances of the actual steps that you can take to select non-forfeiture options, I would also remind you of the golden rule. Nelson said it best in Becoming Your Own Banker. He said, the golden rule: he who has the gold makes the rules. Be well capitalized. Aren't most financial situations better addressed with ready access to liquid, accessible capital? Yes. So be well capitalized. Okay, let's talk about some of these non-forfeiture options. They're not necessarily in any order, although I would say that some of these non-forfeiture options, or some of these steps that you can take to navigate through a financial difficulty, some of these are more severe, some of these are more drastic, and some of them may even be permanent. So they may not be the first line of defense when navigating or weathering a storm, financially speaking. So let's actually start with a very practical, bite-sized step that you could take, which would be to change your premium mode. Okay, so let's say you had an annual premium payment. That doesn't mean that you necessarily have to stick with an annual premium payment. Now, one insurance company may say, well, you can change that at any point in time. Another insurance company may say, well, you can change that on your policy anniversary date. So be familiar with your contract. But if I'm paying annually and I'm coming up on an annual premium payment, but I've had some unexpected financial happenstance occur to me, that doesn't mean that I necessarily have to pay for a whole another year's policy premium. I should change to semi-annual. I should change to quarterly. Should change to monthly. And that'll literally just make it more bite-sized for me to pay the next month's premium than the whole next year's premium. And that could even be a step as simple as calling the insurance company or logging in through your online portal to make that type of a change. But it's a good one. I've used it. I've had highs and lows financially over the past 10 years. Perhaps you have too. And I have used quarterly, I've used semi-annual, I've used monthly, I've used annual premium payments over this system of policies that we've created, which we have 7 now. I recently got approved for another policy. Say congratulations with me. Another step that you can use so I should have perhaps even begun by saying non-forfeiture options. Obviously, we're not looking to forfeit the ownership, the control of this policy. So non-forfeiture options are options that allow us to keep the policy and navigate through perhaps a financially difficult situation. So another step that we can take beyond changing the premium mode is, let's say we even change that premium mode. I go from annual to monthly, and yet this situation seems like it might last longer than I first anticipated. Perhaps it ends up being bigger than I even first anticipated. I can elect to just pay my contractual minimums instead of fully funding the policy or paying my full regular scheduled premium. I may not pay anything towards my paid up additions rider, let's say, and with a traditional build, typically speaking, the greater portion of premium goes to the paid up additions rider. So I could even be paying less than half of my normally scheduled premium by just covering my base premiums and my term premiums. Now, it is important to mention the term premiums right there. If you do have a term rider on your policy, you would want to be paying your base premiums and the term premiums, and then just be foregoing or stalling on or coming back to paying paid up additional premiums into the paid up additions rider when you could. But that would greatly reduce the amount of premium that you would have to pay in any given moment. Again, being familiar with your particular contract. Now, another step that you can take either intentionally or it will just automatically happen is that policy loans may be taken from the policy contract to pay ongoing premiums. So I say intentionally because when you take a policy loan, the insurance company's not asking you what that policy loan is for. They're just asking you, out of what is available to be loaned to you, how much do you want sent? And then do you want a check in the mail or a direct deposit to your account? And if you take that capital, if you take that money and then pay an upcoming premium, you've paid the upcoming premium. And in fact, if you didn't, most companies and policies are going to be set up in a way, but be familiar with yours, to where if you didn't intentionally pay an upcoming premium and there is a cash value in the policy loans would just automatically extend to cover ongoing premiums for as long as there is a cash value. So another non-forfeiture option is to access policy loans to navigate through paying premiums. And here I'll add, how convenient, how proactive, how admirable is it that if you have been capitalizing into a policy and you have an unexpected financial hit, what greater place, what greater method is this that you can now access policy loans, not just to pay ongoing policy premiums so that you don't have to forfeit the policy itself, but you can tap into contract stipulations to have access without asking permission to help you navigate at home on the home front. You could be using policy loans to take care of that emergency. So again, that just underscores my earlier admonition to be well capitalized. So there's something to be said here about not necessarily taking maximum loans from policies so that you do maintain a reserve level of capital, and you're the one who's going to determine what that is. Perhaps there's a certain money amount, a certain number amount, or perhaps there's some percentage that you would like to keep in the policy just for these types of contingencies, these exigencies that can pop up. So be well capitalized. Remember the golden rule. But policy loans themselves can be a great resource to you in the event that you're looking to implement non-forfeiture steps to maintain your policy. Another non-forfeiture option is using the dividends. So dividends, and Nelson talks about this in the Becoming Your Own Banker book, how he actually for the first 15 years used premium offset. So he received a dividend from a dividend-paying mutual life insurance company, and he offset his out-of-pocket premium amount for the first 15 years of having a particular policy. Now, for the purposes of infinite banking, we're not looking to do that for 15 years or even 15 months if we don't need to. But again, that is an option that you have, that depending on what point in time you're experiencing some financial difficulty, the dividend may be of a significant enough amount to significantly offset or even cover the cost of ongoing base premiums. And that's a very cool thing to see happen. And we have Nelson's own experience to glean as an example. So premium offset by using the dividend is another non-forfeiture option. Another non-forfeiture option is surrendering paid-up additions. So when you've paid premium into the paid-up additions rider, and that's bought you more insurance and it's increased your cash value, also it would increase your eligibility for dividends, but you can surrender paid-up additions, meaning the insurance company's already guaranteed now. At the time that they give paid-up additional insurance, that's bought and paid for. They're on the hook for it. But if you surrender that to them for a cost, then that can be a non-forfeiture option as well. Nelson talks about that in different examples in his book. So I would encourage you again to get back in the book where he's talking about that. Now, again, that's not necessarily the optimal way to be doing infinite banking. But again, right here, we're talking about navigating through a financial difficulty. So it's good that you're aware that you can surrender paid up additions as a non-forfeiture option. And really just to get money from the company, it's essentially like a withdrawal. It's not a withdrawal, but it's essentially functioning like a withdrawal because you are surrendering those paid up additions. Another option that you can have as a non-forfeiture option, or just as an option to help you navigate perhaps being able to handle out of pocket the cash flow towards the policy, dropping riders on that policy could lower the cost out of pocket. And again, that could be a permanent move. So be familiar with your contract, be familiar with whether this would make sense for you. But again, I'm just looking to make you aware of these options right here. If you forego paying on a particular rider by dropping that rider, and then you no longer have that expense, you would no longer have the coverage or the benefit of that rider anymore, but it would also cost you less out of pocket. So dropping riders may be an option for you to consider. Conversion to term insurance would be another option here. So an insurance company may offer the ability for you to convert a whole life insurance policy to a term insurance policy under certain situations and under certain terms. So that may be an option where you could maintain some coverage for a period of time by converting that whole life insurance policy into a term policy. And of course, term policies typically cost less than permanent style policies. So that could be an option for you, although very generally not advisable, but depending upon the individual situation. Another non-forfeiture option is RPU, to reduce pay up your policy. So reduce pay up. Now this is an option that would take place after the first 7 years of owning a policy. So typically speaking, what that's going to mean is that you would be accepting a lower amount of death benefit to allow for no more ongoing premiums to that policy. So no more premiums. So it would reduce the death benefit, but you would now not have any more out of pocket premiums to that policy. So this is a permanent change to your policy. It's not reversible. It cannot be undone. But again, there can even be strategic reasons as to why someone would want to RPU a policy, even in the absence of a financial exigency. So it is an option that you have. Look for a more detailed video explaining RPUing a policy on the channel. But here it is, an option for you to not forfeit the policy, keep it under those conditions. Another step that you could take with a policy is to exchange that policy. So there is something called a 1035 exchange, which is when you take one policy and exchange it for another. So typically speaking, that's going to be for one cash value style policy to another cash value style policy. Now, this is not a non-forfeiture option, but I am mentioning it here just because a policy is a private asset, and this is an option that you have to do with this property that you own. Now, in almost every case, or at least the vast majority of cases where someone has a whole life insurance policy, it does not behoove one to 1035 exchange that policy for another, especially if it has some years of maturity. So again, this is another one of those topics that you can look for further information on my channel, but it is possible to exchange one type of a policy for another. It may typically need to be, of course, with the same insurance company, and there are going to be other stipulations, so be familiar with that. And again, just recognize that with whole life insurance, that's not typically going to be advisable. As long as that policy is with a good 100+ year old company that pays dividends and that is a mutual company and perhaps even a stock company because of the guaranteed growth and the access to capital via policy loans. And then the final option that I'm covering today is surrendering, selling, or transferring ownership of the policy. Now, there's a strategic reason why you would want to transfer the ownership of the policy. And for those that are implementing infinite banking, I'll give you a very great and admirable example. One example could be to transfer the ownership of a policy that I have, say, on my person to our children or to a trust where our children are going to be beneficiaries. But to transfer that ownership to someone else to where the premiums no longer come out of my pocket because perhaps I'm looking to enjoy passive income and I don't want to be paying those premiums out of pocket, but the next generation could assume the responsibility of paying those ongoing premiums because they are the ones who expect to experience that windfall. And then there I am, not having to pay the ongoing premiums, but the next generation gets to pick that mantle up. And of course, they will be the recipients of that tax-free income windfall. So there, a transfer of ownership could be a great step in transferring ownership to the next generation. Now, surrendering the policy is one of those worst case scenarios because we never know what the future holds. We never know if we're going to be insurable in the future. We're going to be losing all of the maturity that we may have experienced in that policy. We're no longer going to have guaranteed coverage. So there are lots of reasons why surrendering a policy obviously is one of those worst case scenarios. My perspective on infinite banking and whole life insurance, my policies are going to be the last thing that I keep and the first thing that I protect and maintain. That's just where I'm at. That's our foundation. That's our baseline. But surrendering is an option, and I'm making you aware of it. And a whole life or a cash value style policy is going to have a surrender value to it. It's an appreciating asset. So when you surrender that policy and choose to no longer own that contract, you'll be paid whatever that surrender value is. Now, there may or may not be tax implications there. You should be familiar with those, but surrendering the policy is an option. And then selling. Again, this is one of those things in this space that it does not behoove you. In fact, the insurance company will ask you a question about, have you sold or do you intend to sell life insurance on your person, because they view it as selling your mortality. And it's more than frowned upon. They're just likely not going to give you another policy if you've sold a policy, or if you intend to sell a policy, they're just probably not going to give you another policy because they're seeing you as selling your mortality. So it does not behoove you. Although I'm not saying that there's never a case where that could monetarily be an option that you should consider, because it might be. So I'm mentioning it because it exists. People have sold policies before out of exigency or for whatever reason. It does not behoove you for so many reasons, because if someone else even purchases that policy, that's a certain amount of death benefit that you are no longer going to be able to acquire for yourself or reacquire for yourself. Everyone is only eligible for whatever amount of insurance that we are eligible for. So it's almost never advisable, even in the worst of situations. But it is an option. It has been done. That's certainly not a non-forfeiture option, though, because you would be selling that private property to someone else. Now, at this point, with me already having said that our policies are going to be the first thing that we seek to maintain and to protect, and it's the last thing that we would part with, financially speaking, it's worthwhile pointing out that being creative with doing what you need to do to keep your head above water is so much more easily done if you have been proactively capitalizing money into a private collection system of assets that you own. He who has the gold makes the rules. Someone is going to control the banking function and profit from it in your life. My encouragement is that it would be you, for you, and yours. So if you got value out of this video, make sure to subscribe to the channel here, and I'll see you on the next video.